John Tsiros from Securinvest Financial Planners. Welcome to another edition of Securinvest's Updates. It's a great time of year to start planning for your tax for the end of financial year, and what I'd like to share with you is a few ideas that we use with clients in addition to a lot of the planning that we do throughout the year. Some particular things that happen this time of year which come up on the radar, and you don't want to be left right until the end of June before you look at them. Look at starting to plan for those things now. What I'll do today is break the presentation up into 4 different areas. Firstly, around superannuation. Secondly, around investments and investment planning. Thirdly, I'll be looking at a couple of ideas in relation to insurance, in particular income protection policies. And lastly, I just want to talk about self-managed superannuation funds and some strategies that are particular to those type of clients. For those of you who are employees in a business, you might be entitled to possibly some bonuses in this time of year. What we often encourage clients to do, particularly if they don't need that bonus for their own cash flow, is if they're able to salary sacrifice that amount directly into the superannuation fund prior to the end of financial year, they can really reduce their tax on that bonus. And yes, you can't access that bonus once it is in superannuation in most people's situations, but it does mean that you're putting more money aside for your future, which it can only be a good thing. For those that are self-employed, and also particularly for retirees as well, that we see, there can be an advantage of claiming a tax deduction for certain types of superannuation contributions, and we often see that this time of year because we get a profile of a person's income during the financial year. If there's an advantage to be able to claim a tax deduction before the end of June, in addition to doing that, you're actually saving more into your superannuation fund, and that can be of a great benefit. Using superannuation contributions that are of personal nature, not going through work, but people that have the ability to contribute large sums into superannuation this time of year is particularly important for them, because what it enables you to do, due to how the tests work, is it is a financial year test. So the limits are put in place around financial years, and you can use a pre-30th of June contribution as well as a post-July contribution to maximise what you can actually put inside your nest egg. So that is a really important strategy that we use for this time of year for clients. One of the extra benefits of those personal contributions, depending on the client, they may be eligible as well for a government co-contribution of up to $500 by doing so. So it is, again, a good time to review those contributions. Spouse contributions is another area that is often overlooked, and what can happen is when contributions are made for a spouse, particularly a low income earning spouse, the person that has put the money into superannuation for them is eligible for up to a $540 tax rebate in certain situations. So that can also be an extra little kicker in your tax return that a lot of people don't know about. With investment review that happens this time of year, what we tend to do is to reevaluate the portfolio that a client holds, and we look at from the angle to say, well, okay, if we are looking to offload some investments, this could be a good time to do that. In particular for investments that might have, you might be sitting on capital losses with them. What we can do is reevaluate it. If there's a benefit of selling some of those investments before the end of June, realising that capital loss, what you can possibly do is reduce some tax that you've made on other investments that have grown in value. So again, it's a really important time to reevaluate your portfolio and maybe take some of those losses so that you can reduce tax on other income that you've made for the year. Conversely, on the flip side of that, you've got the situation where if you are sitting on capital gains on a particular investment, but it is an investment you are looking to offload, maybe you can defer realising that investment until July, so that way it doesn't actually come onto your tax return for another 12 months. So just by being smart about how you manage your capital gains and losses, can really have an impact on your tax savings as well. Investment loans are another area. Always good to take stock of those this time of year, in particular for loans that you are able to prepay for 12 months. Often, if you can bring forward that expense and prepay that amount in June, that can do is that gives you an immediate tax deduction for your interest on your investment loan, and therefore, again, you obtain a very strong tax benefit on this year's tax return. The third step that I wanted to talk to you about today is the insurance, in particular income protection insurance. A great time of year to be reviewing your income protection, mainly because it is a totally tax deductible expense in most people's situations. So what we tend to do is, if we review an income protection policy, make sure it's all suits the person's needs and it all still is competitive from a premium point of view and from a benefits point of view. What we might then do is, if we can pay the premium by the end of June, that effectively gives you a tax deduction that you would benefit from immediately. The other area of insurance that we review this time of year is insurance held underneath superannuation. A lot of us have superannuation funds that hold insurance. In a lot of cases, it's important to really know what you're covered for with those sorts of things, because it probably doesn't surprise you that a lot of people don't realise what they're covered for. So again, it's a good time to review that, look at what levels of cover you do have under your superannuation, and also, is it the best area for you to be insured? And that's an area that you really need to have a discussion with your advisor about the pros and cons of having a superannuation fund owning those type of policies for you. The final step I wanted to talk about today was self-managed superannuation funds. As I've talked about today, it's reviewing all those things along the way. So reviewing your contributions. Is the super fund structured in the right way for this time of year to get the maximum benefit for the client? So evaluating what the client has been doing for the year and allocating the contributions accordingly is one of the really important areas to look at. Self-managed funds can often be in pension phase as well. So when we're sitting down with clients, looking at clients that have been in pension phase or possibly going into pension phase for this financial year, there are obligations that you have to meet to ensure that you get all the tax concessions along the way. And what we do is, rather than waiting right till the end of June before we reevaluate that, we do that now, ensure that everything's ticked where it needs to be and everything is as it should be within pension funds for our clients. I touched on before about reviewing portfolios. That's really important also for self-managed superannuation. The reason being is because we have a lot of clients who want to transfer assets inside their own super fund. They might have a shared portfolio held in their own name. So by transferring some of those shares or investments inside a super fund, that can trigger that capital gains or capital losses on doing that transfer. So for the reasons I outlined earlier, it's a good time to reevaluate and revise the investment strategy of the super fund. There's also an obligation now to ensure that you consider insurance within a self-managed fund. That is now an obligation under the requirements of being a trustee of your own self-managed fund. So it's one of those things that we tick off to make sure that, again, things are done in the right way. And if the client doesn't require insurance, it has been considered, and if it has been considered and that there's a need for it, then it is implemented in the right way. The final area that we evaluate in a super fund is death benefits and reversionary nominations. Basically what that means is to ensure that if something happens to the client, if they passed away suddenly, that the super fund is in good hands, the funds go to the right people at the right time within the super fund, and that might mean setting up pensions for dependents or having lump sums paid to adult kids, or the income might just continue for the surviving spouse for their life. So all those factors can come into it, and it's good to have that discussion with the client this time of year, just making sure again that they're comfortable with how their super fund is set up. As I mentioned, it is a good time of year to be reviewing your self-managed superannuation fund, usually because the financial accounts are all prepared and ready to go. We can sit down and communicate with the accountant as well if that's required. Often some of the strategies do overlay between the accountant and the advisor, and from the client's point of view, at least they know they're getting looked after from a holistic point of view, and making sure that nothing gets missed. So that's all I really wanted to speak about today. Hopefully I've given you some thoughts and ideas to think about, and that might apply to yourself. If there are any questions, feel free to contact us at our office, or alternatively, if you speak to your accountant about any of these issues, make sure that you do seek advice before you implement any of these ideas. But until next time, bye for now.